This is FedWatch on Zacks.com. The Federal Open Market Committee has released another decision on interest rates. The Federal Reserve, working in coordination with other central banks worldwide, enacted an emergency interest rate cut early this morning. The Fed lowered its Fed funds rate by 0.5 percentage point to 1.5%. Central banks said this was necessary due to the worsening crisis in the global financial markets. Here now to help us further understand the move and its impact on the markets, Charles Rotblatt, our senior market analyst. So, seems on the surface like a good move. You seem to be overall happy with it, but is this really going to free up the logjam in the credit markets?
We don't know. I think it's good that the Fed and the European Central Bank, the Bank of Japan, the Bank of Japan, Bank of England, Bank of Canada, Switzerland, we can go down a list. Several banks acted. This was a coordinated rate cut. Bank of Japan did not cut rates. They were supportive of the policy, but their rates were already at 50 basis points, so there wasn't much room for them to cut anyway.
Right.
But I do think it's a step in the right direction. It's good to see the central banks act. Good for them to show traders that, yes, we're aware of what's going on, and we're going to continue to do things. This said, I kind of think it was $1 short and a day late. Really, I would have preferred to see a full percentage point cut come before trading started Monday morning. I think that would have helped. However, when the rate cut was first announced, stock futures jumped, losses in Europe were paired. It seemed right before market open, and we're filming this right now at 9:30 Eastern, so I'm not seeing the market open, but it seemed right before open. Futures again reversed course and headed down, so there's a little bit of uncertainty. It's important to realize we're dealing with a psychological problem, as I have said before. It really is that lenders do not trust borrowers, and cutting rates isn't going to solve it. However, a lot of people want to see the rate cut. It makes credit that much cheaper, and it's a step in the right direction. So I think in this case, anything that central banks can do to be proactive is a positive step, including cutting rates, although I don't think cutting rates itself is going to solve the problem.
This is the 8th cut since September of 2007, the second outside of a regularly scheduled meeting. The next meeting for monetary policy is a 2-day session that concludes on October the 29th. So does this now all but confirm that the outlook for economic growth is even murkier than before?
It's completely murky, and I was talking to somebody yesterday actually doing a television interview, and one of the things I mentioned is that when we look at estimates for next year, typically in September, as is the case anytime when we get between quarters, the number of estimate revisions we see drops. Not just negative or positive, but we see fewer analysts making changes. And there's a cyclical occurrence. So when we look at what brokerage analysts are forecasting for 2009, most of the forecasts don't factor what has happened in September and early October. So it's very murky as far as next year. Nobody really knows for sure when this credit crunch is going to end, when the economy is going to rebound. So when we look at forecasts for 2009, I think everybody's forecast is suspect, and anything I say right now could be completely wrong 3, 4, 6 months from now.
3, 4 minutes from now.
Very possibly.
At the rate things are changing. But if they were to make another rate cut at that meeting at the end of October, that would really be kind of soon, wouldn't it, for this to actually have any kind of an impact?
Right. And again, I think we're dealing with psychology, and it may very well be that the central banks look at this, realize that we should have been more aggressive. People want us to be more aggressive. And I think one of the things that might have held back the central banks might have been Trichet with the European Central Bank, very much an inflation fighter. And although I understand that he sees his mandate as to fight inflation, I think he's trying to basically go at windmills with paper. He really, instead of seeing what's really going on and saying the big problem is not inflation but preventing the economy from falling apart, he's been overly concerned with interest rates. And I think I don't have actual basis to say this is fact. It's speculation on my part, and I want to stress that to everybody. But I think on his part, I think he was overly concerned with inflation as opposed to let's just slash interest rates. Let's show everyone we're going to be as accommodative as we need to be and to get lenders loaning money and get borrowers the ability to borrow money. We're not seeing it yet. But as I said, it's still a step in the right direction. The central banks are being proactive. They're also being reactive. And I think it's good to see that they're not sitting on the sidelines trying to fight the wrong battle. They are starting to get it, even though they may not be as aggressive as everyone would like. It's still a step in the right direction, and I think the central banks need to be lauded for that.
Now that they've begun acting in concert, central banks around the world, any further action, does that also have to come in concert, or can they begin to break away and act on their own?
They have been acting on their own, and I think it's hard to say what the actual solution is. When you have somebody who doesn't trust somebody else to loan money, it's really hard. I actually saw a quote from one of the heads at PIMCO, and he had a very good explanation of it. He said, if you're at a drive-through, you pull up the first one and you pay your cash, and natural expectation when you drive 50 feet further down the road, you're going to get a burger waiting for you.
Right.
But if you don't know that the burger is going to be waiting for you at the next window, you're not very likely to pay cash at the first window. And that's the situation we're at right now. If you don't expect that you're going to get repaid on your loan, you're less likely to make that loan. And it's really hard to say what's going to get lenders to trust that, yeah, if I pull up to the first window and pay my cash, that, yeah, I'm relatively certain that when I go to the second window, I'm going to get that burger.
So this is certainly not a straightforward situation.
It's not a straightforward situation. It's really unclear what the true answer is. But I think the key takeaway for investors is continue to focus on the long-term strategies that have worked over time. And that is buying fundamentally sound companies with rising earnings estimates, trading at attractive valuations. Dollar cost average in this market. It's hard to say when a bomb's going to occur. It's hard to say when a recovery is going to occur. But if you dollar cost average, you limit some of your exposure right now to any more downside risk, but you expose yourself to any upside rebound. Similarly, if you have a portfolio right now with stocks, take a look at it. Ask yourself, are the reasons why I bought this stock, do they still apply? And if the reasons why you bought a stock no longer applies, sell it and find a better stock. But you don't have to buy right now. You can take your time and look and have a shopping list of things you would buy if the price is right. I think it's important for people to maintain some allocation to the stock market, but certainly nobody should hold on to an investment that keeps them up at night.
All right, Charles Rotblatt, Senior Market Analyst at Zacks.com, filling us in on the particulars of the emergency Fed rate cut, Fed acting in concert with 5 other central banks around the world to cut rates in an emergency session. With Charles, I'm Terry Ruffalo.